everyone. Welcome to the Money Compass podcast. You have come to the right place if you're looking for critical advice on ways to help guide your direction toward a healthy financial future. I'm your host, Christina Pullman with Penn State Extension. I'm an extension educator leading our statewide financial literacy efforts, and I'm thrilled to be joined by my co-host, Brady Ward. Brady, I'll let you share about yourself.
Hello, everybody. My name is Brady Ward. I'm a junior here at Penn State University Park studying finance, and I am part of the Sokola Miller Family Financial and Life Skills Center as a student ambassador.
Excellent. Thank you, Brady. Well, today our topic is all about credit. Investopedia defines credit as a contractual agreement involving borrowing and often includes repaying with interest. The concern is that far too many people fall into the trap of treating credit like free money. Today, we want to dispel that myth and set you on a sustainable path toward financial wellness. So sit back, relax, and enjoy as we share the best practices from experts in the financial field. We are being joined today by our two guests, Beth Kocsis and Alison Beichner. I'll let you both share a little bit about yourselves. Tell us your role and your connection to the financial field. Beth, would you like to start?
Sure. Hello, everybody. So nice to join you all today. My name is Beth, and I am an extension educator in the southwestern part of Pennsylvania. I reside in Allegheny County, and I am on the Extension's Food, Families, and Community Unit and the Financial Literacy Team. So happy to be here with you all today.
Thank you, Beth. We're happy to have you. Alison?
Thanks, Christina. I'm Alison Beichner. I am located up here in Clarion County. We're in the northwest corner of Clarion County. I work for Horizon Farm Credit as a young, beginning, and small relationship manager, which means I work and specialize working with young, beginning, and small part-time farmers and full-time farmers. Horizon Farm Credit is a rural lending cooperative that covers over 100 counties in Pennsylvania, Maryland, Delaware, West Virginia, and Virginia. I cover our Allegheny region, which covers about 40 counties in western Pennsylvania.
Excellent. Thank you, Alison. We're excited to get started with our discussion today. I'm going to turn it over to Brady.
Perfect. Thank you, Chrissy. So I'm going to start with Alison here for the first question. Can you just explain a little bit background information? What exactly is credit?
Yeah, so a lot of times I get questions from individuals because they'll say, well, I don't have credit, or I haven't built up any credit yet. But really what they don't recognize is that it just means they haven't done anything to generate a credit score. That doesn't necessarily mean that they don't have quote unquote credit. In the credit world, we actually deal with 5 C's that we call the 5 C's of credit. They are character, capital, capacity, collateral, and conditions. They're pretty easily explained, and I'll list them here and I'll run through them in the order of what we kind of consider most important to maybe least important. So number 1 is character. So someone's character, is defined as how trustworthy they are. So, you and maybe a friend are out somewhere and you forgot your wallet, and, you lend them $20 to buy lunch or something, and they say, hey, when we get back to the car, I'll grab my wallet, I'll give you that $20. Well, if you constantly have to pester that friend for that $20, it doesn't show a very good character of them that you're going to repay them at any point in time. And that's one of the things we look at. This character is oftentimes measured by your credit score, which we'll talk about a little bit later. Capital is everything you own versus everything that you would owe. So it's your personal investment in your financial situation, or your personal investment in your actual business. This oftentimes is reflected on what's called your balance sheet, which is a list of your assets and your debts, and therefore determines your overall net worth or your equity. Capacity is someone's capacity to repay their loan. And this is oftentimes what you think of when you're trying to make your monthly budget. So It's the income that you have that you know is coming in on a regular basis. That capacity is your ability to repay your loan based on your current income and your current debt obligations. The fourth of the C's is collateral. And oftentimes this is what people think of the most when they think of a loan, because they think of, well, what do I have to pledge as collateral? Or what is the bank going to take as collateral? Or in the event of the worst case scenario, what will the bank take back if I default on my loan? And collateral is basically an asset that secures a loan, so it's not just what we would call an unsecured loan. So collateral may be the title to a vehicle. Conditions is our final C. And oftentimes, I don't want to say this isn't the most important, because all the 5 C's are important, but it's a way that we can strengthen a potential request from someone that might not have any credit. And a condition basically reduces the risk of the overall loan. So it might be that you have to carry insurance on your car or on your house in the event that you have an accident or a fire, so that the loan can be repaid, or so that you can rebuild that asset that was there. It may also include a discount on your rate, or it may also outline what your rate is supposed to be based on certain market conditions that are out there. So a condition is really more something that surrounds around the action of the loan that involves eliminating some risk.
Thank you so much, Allison, and credit broken down in those type of ways, but that was very informative to not only me, but hopefully our guests as well. So I'm going to turn to Beth for this next question. So now that we know what credit is, or the outline of credit, what are some advantages of using a credit card, and maybe what are some risks as well?
Yeah, thanks, Brady. So there are a bunch of different advantages to using a credit card. First and foremost, they're universal, right? So whether you're grabbing dinner, shopping online, if you're traveling and need to reserve a hotel room, your credit card works just about anywhere. They also back you up in emergencies, right? Accidents happen, you need more new tires, at any point you could be hit with an unexpected expense, and that credit card is going to let you borrow the funds that you need now. They could help manage spending, so it's a valuable budgeting tool. You can see exactly where your money was spent. You can see what you have left. So if you pay off your credit card balance by that due date every billing cycle, you're able to avoid interest, fees, late payments, as well as any credit card debt. They can also improve your credit score. So your credit history begins when you open a line of credit. And in order to build good credit, you have to show credit bureaus that you're using that line of credit responsibly. So, avoiding credit card debt is really key to avoiding that high credit score. And finally, for an advantage, they offer protection against unauthorized use. So if your card is compromised, the credit card company can cancel it and send you a new credit card. But there are also some cons of using a credit card. So first of all, there is a risk of overspending. It could get really easy to lose track of how much you're spending when you're using a credit card. So, it's also convenient. So you have your convenience and you're coupling that with your ability to spend up to your credit limit. So that can work against you if you're tempted to overspend. And if you do overspend, that can lead to carrying that balance, which means you're paying interest and potentially falling into debt. And then if you're juggling multiple cards or making only, your minimum payments, that can create kind of a debt spiral, and it might make it harder to catch up with those high interest charges. Another disadvantage is fees, right? Your credit card might come with different types of fees that are going to cost you money or kind of eat into those rewards. So a lot of credit cards come with an annual fee. They might charge if you add kind of an authorized user or if you take out a cash advance. So those are also some disadvantages.
Thank you, Beth. I think a lot of us have heard of some risk to credit cards and using credit overall, but I always had this misconception growing up that credit cards were always bad. And so I think it was really important to also highlight these benefits and advantages of using a credit card. But
Mhm.
now both guests have mentioned a lot of terminology, and so I'm going to turn to Allison for this next question. What terminology can you maybe cover here that we should be aware of when dealing with credit?
Sure. So I kind of like to think about it broken down into a couple areas. So one is actually like the terms surrounding the loan. And when we think about the terms surrounding the loan, there's kind of three key items there, and that would be your principal, interest rate, and your loan term. So your principal is the amount that you borrowed to start with. So that's going to vary whether you're using a credit card or whether you have a home loan or a car loan. So a car loan and a home loan are going to have a fixed principal. So they're going to start, at maybe 250,000 for a home loan or 50,000 for a car loan, whereas a credit card could vary over time depending on what you're paying back on the principal that's owed. So the interest rate is your actual cost of borrowing money. So there's a difference when you look at the interest rate, which is the amount that's charged to your account on a regular basis. That could be on a daily basis, monthly basis, annual basis. It depends on how your loan is structured. What goes hand in hand with your interest rate is also your annual percentage rate, and that takes into account any loan fees or transaction fees that may have occurred. Transaction fees are what may be charged to originate the loan or what might be charged for some sort of like a convenience fee or something along those lines. So in addition to principal and interest, one of the other important parts of your loan is going to be your loan term. So typically on loans that are tied to, let's say maybe a car or a house, you're going to look at like a 5 to 7 year term for a car or a 30-year term or maybe a 20 or 15-year term for a house. That loan term just strictly means that loan has to be paid off within that time frame, and your principal and interest payments are going to be set up so that it is paid back over that set amount of time. If it's a credit card, typically credit cards don't have a term. They're what's called revolving credit. So the credit just revolves on a regular basis with the idea that you're going to pay down the credit card and then, use it when you need it. But ideally, you should try to pay those credit cards off on a monthly basis.
Thank you so much, Allison. So I'm going to turn to Beth for this next question here. And what exactly is a credit score? I know we've had a few mentions of this. And so can you just briefly explain what a credit score is and how it affects the interest rate that I'm paying?
Yeah, sure, Brady. So as Allison mentioned at the beginning of the podcast, it is an algorithm. So it is a prediction of your credit behavior, and it kind of shows how likely you are to pay a loan back on time based on information from your credit reports. So companies use credit scores to make decisions on whether to, for example, offer you a mortgage or offer you a credit card, an auto loan. They're also used to determine the interest rate and credit limit that you receive. So just a quick some factors that impact your credit score, right? Your bill paying history is going to affect your credit score, your current unpaid debt, the number and the type of loan accounts you have, how long you've had your loan accounts open, how much available credit you're actually using, which is called your credit utilization ratio, new applications for credit, and then whether you've had a debt sent to collections or bankruptcy and how long ago that was. So, how a credit score impacts your interest rate. A higher credit score is truly going to directly result in lower interest rates because lenders are going to view higher scores as a lower risk, which leads to savings on interest over the life of a loan. On the other hand, lower scores indicate higher risk for lenders, right? So that's going to prompt lenders to charge higher interest rates to kind of compensate for any potential default that the lender may have.
Perfect. And so we often check our credit scores. There's also such thing as a credit report. And in our last episode, we talked about identity theft and ways to protect yourself from scams or fraudulent activities. How can you make sure that you protect yourself from identity theft when dealing with credit, especially your credit report?
Yeah, so it's definitely important to check your credit report just to see if there is any information on there that might indicate identity theft. It's a good idea to check your credit report at least once every year, and you can receive free copies of your credit report every 12 months from annualcreditreport.com. And this provides free credit reports from those three major national credit reporting companies, Equifax, Experian, and TransUnion. So you can get a free credit report from each of those credit reporting companies every year. So some folks might check all three of those companies each year, or you can space it out. So you can check Equifax's, 4 months, and then in another 4 months. You can schedule this, right? So when you are changing the batteries on your smoke alarm, you're going to check your credit report. Or if you're changing your furnace filter, check your credit report. But it's important because you can learn, number one, kind of what and when your creditors are reporting to agencies. You also know when something important changes on your credit report, such as, if a negative mark gets removed from your credit history or if a new account gets added. And then, of course, you mentioned identity theft or fraud. So you can look for information that you don't recognize that could indicate identity theft. So when you're looking at your credit score and your report, you want to look for errors. They could be identity errors. So any kind of error to your personal identifiable information, wrong name, wrong phone number, wrong address, an account belonging to a different person that's listed on your credit report, or any kind of incorrect accounts that might result from identity theft. Then you also want to look for any kind of incorrect reporting of your account status. So maybe there's a closed account that's reported as open, or if you're reported as the owner of account, but you're an authorized user and not the owner. So you want to look for those mistakes as well. And then any accounts with an incorrect current balance or an incorrect credit limit, you want to look for those as well.
Interesting. A lot of different things to look for, but it definitely can save you in the long run and is really important to check, especially, like you said, on a yearly basis. So the last question I have for you, Beth, is how can we responsibly use a credit card?
Yeah, so I think most importantly, you always want to pay your credit card bill on time. So paying a credit card bill late is going to have you incur late fees or penalty APRs. So, and payment history is a huge factor. It's actually the biggest factor in your credit score. So that late payment is going to damage your credit. So you want to stay on top of due dates. You can set phone reminders. You can set a calendar reminder to pay your bills, schedule a day, a month to pay all your bills, or you can set up automatic payments to cover at least your minimum amount due. You can also get other text or email alerts that tell you, when your payment was accepted or when you're approaching your credit limit or any kind of balance updates as well. But if at all possible, you want to pay more than the minimum amount. You want to pay it in full each month if possible, because making that minimum payment, that's going to be better than missing a payment for sure. But paying it full every month is ideal because you're not incurring any interest on that amount. And then finally, you want to live within your budget, right? So if you store your credit card information with online retailers, or if you're linking it to like a payment account, it makes spending easy. And, you might be at risk of overspending without realizing it until that bill arrives. So you definitely want to live within your budget. You want to avoid any kind of impulse purchases. And then finally, you want to maintain that healthy credit utilization ratio. So it's that utilization ratio is the percentage of your total credit limit that you're using. So it is a factor that influences your credit score, but keeping it low is really important to show that you're using that credit card responsibly. So generally, lenders look at a look favorably on a credit utilization ratio below 30%. So quick example is if your credit limit is $1,000, you want to keep your balance below $300 to maintain that good utilization ratio.
Thank you so much, Beth, and really great to pull it full circle there on how we can responsibly use a credit card so that we can definitely take advantage of the perks that come with those credit cards without necessarily seeing those risks. Great, Allison. And the last question I have for you is what steps can be taken to build strong credit to qualify for farm loans, especially for young or beginner farmers?
Yeah, Brady. So one of the things I tend to lead my young and beginning farmers in is really following those 5 C's of credit. So yes, building credit through a credit score, through the use of, most simply, most people are using credit cards to get their credit established, or maybe a car loan. Those are all useful ways to start to build your credit, but really you can start building your credit even before you're legally allowed to have credit at 18 years old. Really working on that character, how trustworthy you are, building a good, strong reputation in the community as being a hard worker or a knowledgeable individual, building up your skill set. That really all defines your character. And that's one of the biggest things we look at as a lender, because ultimately when push comes to shove, we want to see that you're going to have the grit to go out there, pound the pavement, and repay the loan, even if the plans you had for repaying the loan may not go the way you think that they are going to go. The other thing that you can really start to do is, if you do have something that you want to do, is start a business plan. Even if you're starting out just very beginning and you're young, you can start a business plan and then keep that business plan open so you can work through it as your business changes. For a lot of our beginning farmers, I see them sometimes more financially established than what I see for some of our younger farmers as they've kind of came up through the ranks. But beginning farmers, whether you be on farm or off the farm and wanting to look into farming, the biggest thing you can do is make sure that you've got a good knowledge base and a good understanding, as well as some experience in whatever you're doing. It's a risk for a lending institution to lend you money when you're a young and beginning farmer because you don't have a proven track record. But if you can try to mitigate that risk by learning as much as you can about a certain area or what you might be interested, you have a business plan in place, it shows that you've really taken the time to think through the possibilities that are out there for business, but also what could happen and how you're going to maybe remedy a challenge that might arise.
Perfect. Thank you so much. And the last thing, as always, just any resources. We can start with Beth for any resources she might have to share, and then we'll move to Allison as well.
Yeah, thanks, Brady. We've got a lot of great financial resources at Penn State Extension, really good articles. We also have in-person presentations, but I just wanted to highlight a few webinars that our financial literacy team presents. The first one is Your Money Matters. It's a 5-part webinar series and includes information about budgeting, credit, debt, goal setting, and identity theft. So a really great 5-part series. Another one is our Financial Foundations series. And this actually comes with a micro-credential badge upon completion. And then finally, I just want to highlight our 3-part Boosting Financial Wellness series. This helps participants organize finances. So we talk about financial clutter. We also talk about money and nutrition, so incorporating and connecting money with healthy habits, and then money and relationships, so how to build stronger financial relationships.
Thank you so much. And Allison, do you have any resources you would like the listeners to know about?
Yeah, sure. So one of our flagships here at Horizon Farm Credit has been our AgBiz Masters course. Our AgBiz Masters course is a 2-year program. In year 1, we learn a lot about what I like to call the nitty-gritty numbers. So It goes through balance sheets, cash flow statements. It really talks about knowing the numbers of your operation and explaining what those numbers mean. And then the second year goes into more of some high level detail and overview, where it might overview transition planning and succession planning, as well as, how to manage personnel challenges, or potentially evaluating a strengths, weaknesses, and opportunities. We also do offer several webinars throughout the year. We keep all of those recorded. So if there's an interest area, we can share those recordings with someone that might need some information. In addition to that, we do have a couple youth curriculum programs that can be presented in the classroom. And to our customers, we also have a knowledge center, which is a joint venture with Farm Credit of the Virginias that provides a lot of worksheets and information on various different financial areas that would apply to young and beginning farmers.
Perfect. Thank you so much. And I'm going to pass it back to Christina to close out the rest of this podcast.
All right. Well, that was an excellent discussion. Very important tips, resources to help our listeners understand that if they're going to utilize credit, it really should be done responsibly. Paying attention to those 5 C's of credit, consistently monitoring our credit report and our credit score. When we're clear on how credit really works and make those smart financial decisions, we can start using it as a tool and not as a trap to improve our financial future. So in closing, we encourage you to check out Penn State Extension. As Beth shared, there's a lot of great programs and resources for you to stay financially on track. You can find us at extension.psu.edu. And Brady, tell us about the center.
And of course, as always, the Sokola Miller Family Financial and Life Skills Center can be found at financialliteracy.psu.edu with also a ton more resources on financial literacy topics.
Very good. Well, we want to thank our guests, Beth and Alison, for all of that wonderful information and for coming on with us today. We want to thank our listeners for joining. Be sure to join us for the next episode of The Money Compass.